what we're going to be going over here is accounting for providers of healthcare services, and for our discussion we'll do it in terms of hospitals here. But there are other healthcare providers here other than hospitals, but looking at it in terms of hospitals here. And we can either have governmental or privately owned hospitals or healthcare facilities here. Now, healthcare hospitals really fall into three different categories. First, you can have the investor or privately owned hospitals, and they would be operating for a profit. And then you would have second tier, you'd have governmental healthcare or publicly owned facilities here, and that would be like veterans hospitals. And then finally you'd have like voluntary not-for-profit. That would be including any religious affiliated healthcare providers or hospitals. Now, the accounting and reporting varies between GAAP here and GASP. But in general, healthcare entities and these hospitals that we're going to be looking at use fund accounting. And when we talk about fund accounting, we're talking about typical not-for-profit accounting or governmental accounting. Okay, so what we have to do here for these healthcare providers or these hospitals that we're going to be looking at, we're going to have to determine the different fund classes that we're talking about. And now when you talk not-for-profits and governmental accounting, you also have to set up, as you would here for the healthcare services, you have to set up your fund asset categories here and or the resources you have to. And you have to classify these different funds here according to restrictions that are set on these funds. Either there's, and what we talk about restrictions, those are outside restrictions or third-party restrictions, any dollars they contributed, donated, or resources that they've given to the particular, in this case, our healthcare providers or our hospitals. And they would have to be classified here. You're going to either have permanently restricted assets here, and what we're talking about for reporting, we're going to have to report the balances here on, for our different net assets for each of these different funds. So you would have like permanently restricted net assets here, then you'd have temporarily restricted assets, and then unrestricted net assets. And this is, again, restrictions that a third party or outside parties make in their contributions of resources or monies to the hospital. And what you have to do in typical fund accounting here, if there is a temporary restriction here, in order to spend the money or to recognize revenues, you have to do some reclassifying any temporarily restricted monies or resources into the unrestricted, in this case, resources or net assets. And you do a lot of transferring between your temporary restricted account here and the unrestricted account. And also there's permanent restrictions, but there's also reclassifications there. Okay, so let's really look at our different fund classes here. And we really have got two main classes here. We're going to have our unrestricted funds here, and then our donor restricted funds. So we'll go through these here. First, just the basic funds themselves here. For our unrestricted net assets, that means there's no restrictions on the spending here, versus temporary restrictions. You're going to have restrictions on the spending and also permanent restrictions. But in our unrestricted funds, you have the general fund here, you're going to have a board designated fund, and then the agency funds. And we'll go through these, brief description of these here. But first let's go into, we'll talk about our fund classes here. And then we come into our donor restricted funds. The unrestricted funds were here. Now we got the donor restricted funds. Those are donors that are contributing assets or resources here to the healthcare facility or the hospital, and they put restrictions on how those funds and resources and monies can be spent. And for the donor restricted funds, you're going to have a specific purpose fund here. Again, falls under any of these three fund asset categories. All of them do here when you have donor restricted funds. And then you're going to have a plant and replacement or expansion fund, and then the endowment fund or other donor restricted funds. Okay, so we'll look at a brief discussion of each of these here. But just for our not-for-profit healthcare entities, really these funds that we looked at are going to be structured around the rule here of restricted money or dollars or resources here. The key is if restricted funding dollars here are received here, or some resources are received, you do not recognize revenue and expense until after the dollars here are spent for the intended purpose. So that's what we're talking about, restrictions. You can either have a time restriction or a purpose restriction, but in order for, again, our general rules here and these funds, when they're set up, they're structured around the case here where, again, you don't recognize any revenue expense until any monies is spent for whatever purpose or restriction that was set on it here by the outside or the donor party. Okay. Now let's go up here and let's just see here our healthcare services. So what are the funds here and what's included in them? So we talked about those two different funds. We have our unrestricted funds and then we have our donor restricted funds. So starting out with our unrestricted funds. First we talked about our general fund. That's going to account for dollars not restricted in any way here. So those dollars can be spent in any way. And then you have the general fund accounts for the day-to-day operations here, and we look at it in terms of a hospital here. And then the general fund, they carry the fixed assets here are carried in the general fund. That is, the fixed assets carried here, and you're going to have depreciations and irregular GAAP accounting going on here in your general fund. Now, second, we have the board-designated fund. That's where the governing board here of the healthcare facility or hospital here, they can set up their own fund for projects to expand like outpatient facilities and so forth. So they can set up their own fund here. And dollars coming in can only be used for the designated project here with this fund that they set it up for. So they are essentially putting some restrictions on it here, but those are internal restrictions. Now, they're considered unrestricted here. The last point is they're considered unrestricted dollars here, these board designated funds here, because the board can change its mind here and use the money in another way. So you may see a temporary restriction on it here, but in general here you have to consider it unrestricted because they can change it in another way. That's just a point that we want to make under these board designated funds. And then the third fund here would be the agency fund. That's where the healthcare facility or hospital here acts as an agent for someone else. Monies is just passing through for whatever purpose. And then we get down to our donor restricted funds. That's when a third party says you can only spend the dollars here that they contributed or the resources they contributed in a certain way that the donor specified here. So that what our donor restricted funds, first we'd have a specific purpose fund that accounts for restricted money like state grants and so forth. And then you have your plant and replacement and expansion fund that accumulates dollars here for the acquisition here of fixed assets. And it does not carry fixed assets. That's done in the general fund that we looked up above at. So anything that's sitting, we don't carry or depreciate any of our fixed assets here in this plant and replacement fund. All it does is really accumulate dollars for purchasing fixed assets. And then donated assets are recorded at their fair value here in the plant and replacement fund. Record them at their fair value, and then really they're going to be transferred to the general fund once they're put in. Once they're set out or are going to be used here, they go into the general fund, and that's where they're going to be carried here as a fixed asset. And then our third fund here under donor restricted funds would be the endowment fund. And really we have two different types of endowment funds. First, you're going to have the permanent or pure endowment here. That's where the original principal remains intact. And then you would have the second type here would be the term endowment. That's after a period of time here. The principal can be used here in those endowment funds. So really, you have to make the distinction here. You're going to have two different types of endowments. One where the original principal here, the permanent one, original principal remains intact, and then a term endowment. That's just after a period of time, whatever the donor is specified here, that's where the principal can be used. Now, healthcare services for hospitals, again, for internal accounting, they would be very similar to other fund accounting, and also for external accounting. Now there's differences here between private and publicly held facilities here, but in general here they're going to use not-for-profit organizational type accounting and so forth here, and governmental type accounting, particularly if it's a governmental healthcare facility. Okay, so next let's go on, and we're just going to be looking at some of look at how the income here, revenues and expenses here on these healthcare facilities, how they unfold here, and also look at some typical entries, journal entries that is. Now let's look at how a healthcare provider, in particularly a hospital here, would determine their income here. So we'll look at it in terms of a not-for-profit hospital for calculating the income. So what you're going to start with here is your gross patient revenue here. And charity services, they're going to be included here in this gross patient revenue, but they're going to be adjusted out later. And then you're going to have subtract out here, or you're going to have less your third-party adjustments from your gross patient revenue, and that is really what insurance doesn't pay here on patient services. And it also would be any charity services that would be provided. We would be adjusting those out or subtracting those from the gross patient service revenue here. And then our net, that would determine our net patient revenue here, or patient service revenue after our adjustments here from the gross patient revenue. And then we would have to add in any other revenues, and those would be like specific purpose donations, a cafeteria shop, gift shops, parking lot, and any other services here that the hospital might be providing here. Those would be called other revenues here, and those would be added to the net patient service revenue here, and that would determine the total revenue here, in this case by the hospital. Then we'd have to subtract out or less our expenses, and that would be really anything under GAAP. Even if you're working with a governmental hospital here, you may consider just using GAAP type accounting here for the depreciation, interest expenses, and bad debt expenses. Those would be subtracted out here from your total revenue, and that's going to give you your income or loss here from operations after subtracting out your expenses from your total revenue. Now, this is where you're going to add any non-operating gains and losses. Add those to your income or loss here from operations. In your non-operating gains or losses, those would be unrestricted gifts or bequests made here to the hospital. Any gains or losses from the assets themselves would have to be included. And then any investment income here would be included under non-operating gains or losses. And you would add those to your income or loss here from operations, and that's going to give you your revenues or gains in excess of expenses or losses here. That would be the bottom line here to determine any income here earned by the hospital. And next we'll look at some basic journal entries or entries here for hospitals. That would be particular to healthcare providers or hospitals. So first here, let's just look here at medical malpractice claims here. So they have to be accounted for when you're talking about these healthcare providers or hospitals. They have to be reported to the on their financial statements here. So the reason is they can be really a major expense. So what you want to do with these medical malpractice claims, you must report an estimated liability and estimated expenses on those medical claims. So let's just say these are the accounts you're going to have set up. You're going to have some insurance premium possibly paid here for that medical malpractice insurance, and you're going to have recognized some expenses here. So the basic accounts that you'd have is you're going to have to set up a medical malpractice liability account here. You're going to have to report any estimates that you have in that of a liability for medical malpractice and any added liabilities beyond what you'd have covered under your insurance here. And then based on those liabilities, you're going to also have to recognize malpractice costs or expenses here. So just going through our really basic example here, say hospital pays $10,000 here in some insurance premium here. So in their cash account, it would be the unreserved cash account here. Credit that here for $10,000. and then you have to recognize that as malpractice costs here as an expense here. You would debit that here for $10,000 for the insurance premium. And then just say, for example, you had a malpractice claim here that was beyond, not covered here by the insurance, or it's an estimated additional liability here. You're not pretty sure the insurance isn't going to cover it that you have on for medical malpractice. So what you're going to have to do in your liability account here, you're going to have to credit or increase your liability here for medical malpractice, and it would be an estimated additional liability. And just say it was for $40,000 here. Credit your liability. There's no insurance that's going to be paying this liability, so you have to recognize the liability here, and then going over into your medical malpractice costs as part of the expense here, then you would debit that here for $40,000. That's based on estimates here, and an estimate's beyond what, if you have any insurance to pay for those liabilities, that's beyond what the insurance is. So just remember, you have to state those estimates here when you're talking about large claims or in medical malpractice, and you got to recognize the potential expense here. So the key is here, whether you're covered by insurance or you pay the losses as they occur, the amount of expense should reflect the best estimate of the ultimate cost here of any malpractice claims. Okay, so that's for remember that here when you're talking about these hospitals and you have these malpractice claims. You have to come up with some estimated liability and expense on those. Okay, now let's go up here and let's look at something else here for hospitals. Let's just look at patient service revenue, and we're going to record it here as gross money receivable. And then we're going to have, when we're talking about these hospitals, we're going to have allowance for those contractual allowances based on what the insurances don't pay. We're going to have some bad debt expenses, and also there's some charity involved in here. So what we want to do here when we're talking about our hospital accounting or our health provided services here, what you want to do here is these are things you're going to have. You're going to have your revenue here for patient services. You want to record it at the gross revenues that you're going to receive here, or you're going to bill out on those services. And then later on, you're going to have, well, not later on, but you're going to have to make your adjustments as contra. You're looking at them as either expenses here or contra revenues to your gross revenue. So let's just go through our brief example here. So let's just say we're going to have some accounts receivable here as patient services. Just say we would debit those accounts receivable here at the gross amount here for $200,000. Then moving over to our revenue account here for patient services again, credit it here for $200,000, the gross receivable amount. So you're going to recognize your gross revenue here, and then you're going to make some adjustments to it. And the adjustments that you're going to make to it here, you're going to go through your allowance for uncollectibles here as a contra to your accounts receivable. And we're going to have really three things we have to deal with. We're going to have our, looking at them here, we're going to have contract adjustments. That would be the third-party payers or the insurance companies. They may not pay for all the what was billed on as patient services here to the patient themselves, and the patient's insurance doesn't going to pay for it. So, and you have to make some adjustments there to your gross revenue for those contract adjustments for insurance. And let's just say in our case here, let's say there was debit that here for $2,000, and essentially that's an expense against your revenue here. That's an expense, any of those contractual adjustments, third-party adjustments, insurance companies is particular here. So you debit your contractual adjustments, third-party, and that would go against your allowance of your uncollectibles as a contra to your accounts receivable. Credit that here for $2,000. And then say you have to have some bad debt provisions for the uncollectible accounts. You would debit that here, say for $3,000 for some bad debts that we're estimating we're not going to be able to receive here against our receivables. and that is also recognized as an expense. So debit bad debts here, say for $3,000, and then in our allowance for uncollectibles for patient services, we credit that here for $3,000. And then we get down to our third case here, where we got our charity services. That's where charity care is given here, and we're not going to be able to collect on that. Say it's $1,000 here. And what that is recognized not as an expense, but it's recognized as a contra revenue here. Essentially, it acts as an expense, but the point is you want to look at it in terms of a contra revenue. So let's just say debit that here for $1,000, and then we go up to our allowance for uncollectibles here, credit it for $1,000. So what in our allowance collectibles we had against, which is a contra against our receivables, we have our third-party adjustments, bad debt adjustments here, and charity adjustments. So those have to be made. What you're doing is you're really grouping these items here to show net patient service revenue. So you want to be grouping these items here against your revenue here. So these adjustments here, contractual adjustments, bad debt provisions, and the charity services all are a reduction to your revenue. And you want to group those, understand what's going on. Just make it clear here, the charity services, those act as a contra revenue versus bad debt provision and the contractual adjustments, which acts as an expense here. Okay, so that's what you want to do here when you're talking about patient service revenue. Now let's go down here and just look at typical fund accounting for reclassification here of some restricted dollars. So this would be very typical here of other not-for-profit organizations, and also governmental organizations use this fund accounting, and where we're going to put some restrictions on it. So just for example, say we receive a cash grant here, it's temporarily restricted to be used for some drug study here in the hospital. So when the dollars are spent, then you'd recognize the expense. So what we would have to do, again, we're going to have some temporary restrictions on those cash grants received. So what you have to do is you have to set up accounts here. You're going to have, start out with our entries here. So for our, say for example, we have some cash, $5,000 here that was restricted here for that drug study here. So in your cash, you're going to have to break that out between the restricted cash and unrestricted cash. I've just got them lumped together here, but just say we received the cash grant here, debit it for $5,000, and that has to be noted as restricted cash. And then we go over to revenue here, but what we have to do is we have to recognize it as revenue that's temporarily restricted here. So can't just spend, or this revenue here it's restricted specifically based on that drug study. So credit your revenue account here for $5,000. Again, restricted revenue. Now, when we actually spend that money for that drug study here, this is when we can recognize our expense, and that's going to be an unrestricted expense. But what we have to go through is we have to reclassify this revenue here from a temporary restricted revenue to moving it to the unrestricted revenue or asset account. So what you're going to do here, you have to go through this account here, where you're going to call it Reclassification Out. This is where you're going to release those dollars here to spend. So in your account, it's going to be a reclassification out from those temporary restricted dollars here from that drug study. So you would debit or reduce your reclassification out here for $5,000. This is where you're going to transfer out those monies here and that revenue that was temporarily restricted. And then you go into the reclassification in account here, unrestricted. So this is going to be where we move it out of the temporary restricted account into the unrestricted account. Typical fund accounting here. So in this case, we would credit it here for $5,000 for the transfer in. And then we go and we can actually recognize our expense here, because we spent the money as the intended purpose here. So after making our reclassifications from the temporarily restricted to the unrestricted, then we go into our cash account here, the unrestricted cash, credit that here for $5,000. And then we would go and we'd recognize our expense here as unrestricted, debit it here for $5,000. This is where we actually pay out those grant monies that we received that were initially restricted. But just remember here, what you have to do is when you have those situations where you got some temporary restrictions or you get some permanent restrictions on certain incomes or monies that you can use, or investment monies off those funds, you have to go through your reclassification out. From whatever restriction you have here, you got to remove it out of that move it out of that restricted amount and move it into the unrestricted amount here as reclassification in. So what you're doing is you're just reclassing you're reclassifying your revenue here from unrestricted amount here, and then you can realize your expense. So typical fund accounting, just remember when you're dealing with your healthcare providers here, your hospitals, and you have any restricted monies here in your asset classes, you have to do the reclassification out and reclassification in. And you do that here based on the fact that the funding was, you didn't recognize any expense, and you didn't recognize any, or you recognize the revenue only on a temporarily restricted basis here until you actually perform those services here based on what the restricted money was received for or intended to be spent on. Okay, so we just basically went over looking at not-for-profit hospitals here, and we just went through going through some journal entries here that would be maybe particularly aimed at healthcare providers or hospitals.